Morena, good morning. Welcome to this results presentation for the 6 months ended 30th September 2025. Just a reminder that there's nothing in this presentation constitutes legal, financial, tax or other advice. And we have uploaded this presentation to the NZX. It is available to download the presentation and the interim report. We've also uploaded it onto our website for you. So today we've got Asantha Wijeratne, our CEO and co-founder, talking to you about the interim highlights. I'll then have myself, Jamie Monaghan, CFO, talking to you about the financial results for the year. We will then have some time for questions at the end. If you do have any questions, you're very welcome to send them through in advance to make sure we get to them. You can send them through either through the chat functionality within the portal, or you can email us at investor@paysauce.com. So, without further ado, we will hand over to Asantha to talk to you about the interim highlights.
Thanks, Jamie. It's been a pleasing half behind us. We've had some good success. We continue to focus on building the technology stack, and that's evidenced in the work that we continue to do in the second half of this year of our market entry. We continue to focus on building the New Zealand base. It's about execution and skill. That's been the sort of highlights for us. So that's allowed us to report a ARR of 9.2 million, which is up 6% year on year. And pleasing to say that we've lifted our customer lifetime value to 60.5 million, which is a 20% increase. And the EBITDA number continues to grow, which is up 231,000 to 779, which then led to a bottom line result of 302,000, which is pretty much double the previous half. So that's a pleasing financial result that has continued to give us a platform to launch from. We are, as I said, we're delighted with the increase in the customer numbers and the value that's driving. So where does that leave us now? So the investment that has gone in is about building the global payroll platform, which we sometimes what we call the Gen 2 payroll engine, and that is live now and it's up and running. So that gives us the strong platform, both financially and from a tech point of view, to do that. So the first half of this year has been about building the scale, it's about building the capacity, and it's about people and collaboration across the company. And at the same time, understanding what the requirements are and what the size of the opportunity is in Australia. We've taken our time to understand the problem we're solving and build a solution that speaks to the micro business customers that we're going after. We've always said that we're not interested in just building just another payroll system. We're not interested in competing on a feature basis or on price. It is about solving a real, tangible problem for micro business owners who are really good. They're experts at what they do, but in terms of keeping up with the compliance piece is where we can help them be the best business owner they can, be the best family member they can, be the best member of society they can. And it's a significant opportunity. Just to contrast the size of the Australian opportunity, not just the fact that there are 700,000 underserved micro businesses in Australia, but also that sector is growing between 80 and 100,000 customers a year. So there are a lot of new entrants coming. And when they come in, they will be looking for a payroll solution. And our goal is to be that payroll solution that they will get to employ their first staff member. That's the key thing. It's about being appealing. It's about being easy, simple, and providing a one-stop shop where a simple solution that sits on a mobile phone, they're able to keep up with the compliance. So that is the goal. And it's easy to say, but it's really complex to build. And that's been the learning, that because it's complex, the approach of the micro business owner in Australia to date has been to use a series of different solutions to get to the end result that they want. What we've done is we've brought that solution into the one place. That is the significant difference that we offer. We believe with the ease of use focus that we've got and the customer care focus we've got, we can then get significant traction in getting some early adopters who will then we will use to launch from there and to get to a wider community. So that's the plan. And from Australia, we say, look, everything we do in Australia is about learning, entering into a new market, what's required, what do we need to build, how do we need to do that, which will then serve us when we look to go to the next market beyond that. So that is the plan. We've gone to the sector that has given us the most success and that we know really well, which is the dairy sector. And the response we're getting from that is really positive. We are back again in Victoria this week, working with and talking to a whole number of potential customers for us. And that's part of that learning and refining and making sure we've got this right before we push really hard into it. It's been a progressive engagement, and that's the way we've always been. It's not because we lack ambition. It is about, it's really vital that we get it right before we push on from here. So that is the plan for us. We'll continue to validate the product. We'll continue to report back to you, the shareholders, as to the progress we are making. And we're tremendously excited again as a company. This is the moment that we've been waiting for to make use of the vast knowledge we have, the experience we have in how to serve this customer base, built on a very strong technology platform that gives us a significant edge in terms of entering the Australian market. So I'll pass it back to Jamie to talk about some of the financial result details of the last half.
Thanks, Jonathan. So as you can see, we're very excited about what's to come. But the results that we're generating just now are generated from New Zealand. So an important distinguishing factor here is that the annualized recurring revenue, which is a key metric for us, we earn interest on the float in New Zealand. That's a quirk of New Zealand rules. So when we go to Australia, the interest income is not available to us when we move into that market and into other markets as well. So that interest income is a key component of our revenue in New Zealand. As I said, it's about 20% of the total revenue that we get per customer at the moment. And as you can see, that annualized recurring revenue number is at $9.2 million at the moment, as at the end of September. Of that, we have 7.3 million, which is coming from processing fees. So when you look at the overall ARR number, it's up 6% year on year, and that's despite a 20% year on year decline in the interest income that we've earned in this 6 months compared to the same 6 months last year. And that's just off the back of those wholesale interest rates declining. The float has continued to increase, but the interest earned on those funds has decreased. So the underlying business generated from our customers, the processing fee income has increased 15% year on year coming through. We then look at for the half, we managed an increase in that half year, 4.5 million of the total recurring revenue, up 5% from 4.3 million last year, and that followed through into the gross margin as well. So a similar margin coming through, 3.5 million, up very slightly on 3.3 million last year. And as a percentage, we're proud of the fact that we've managed to maintain that gross margin percentage despite the interest income coming down. And that's really coming through from the efficiencies that we've gained in the cost to serve those customers. So for our gross margin, we recognise the recurring revenue less the cost to serve, and our cost to serve includes our customer support team, our bank transaction costs, and our hosting fees are the primary costs that go in there. So through those efficiencies, we've managed to keep that cost coming down, which has managed to keep the gross margin percentage flat. That flows through then to the bottom line numbers. EBITDA, which is not EBITDA in the traditional sense, because we do include that interest income in the recurring revenue, so it's earnings before tax, depreciation and amortization. We've managed to increase that to $779,000 this year, up $230,000 on the same time last year. And as Sandra spoke about the investment that we've been making into our new global platform, that's where a lot of the cash has gone. So the cash investment has gone through. And a really important point, we've managed to fund that investment, and it's a significant investment into that new platform through the cash that we've generated from our existing business in New Zealand. So with that investment, we've still managed to generate positive cash flow, positive free cash flow of $33,000. So down a bit on last year, but still positive in free cash flow into the business. And our closing cash position as at the end of the period was $272,000 in cash. Plus we have a $350,000 facility with BNZ, which is undrawn, and we just keep that as a surplus there. Moving into the customer metrics, so this is more of the way that we think about our business. This is how we run the business in terms of what we look at when we're running it. So we'll just take you through the customer journey for this. So we have acquisition costs of $577 per customer. So that's for every customer that we acquire, it costs us on average $577 to acquire them through our sales and marketing costs. That transfers to about 6.5 months of revenue. So it costs us about 6 months revenue to bring that customer on. Those customers then pay us a subscription fee, and we earn the interest on the float. So the subscription fee, as I spoke about before, that's about $70 per customer per month, which is up year on year. And the interest income element that we earn on that fund is down, as I said before, year on year. So that comes to $90 altogether per customer per month when you combine those two amounts, which is down very slightly from last year. We then have the cost to serve those customers, and as I said before, that cost is actually through the efficiencies that we've made. We've managed to reduce that cost to serve those customers from $21 per customer per month last year to $20 this year. So we're very pleased with that outcome in terms of the efficiencies coming through the processes that we're putting in place as we scale up. Now, when you take those metrics together and you say, well, how long does a customer usually stay with us? So our average monthly churn is just under 1%. So what that means is, we take the average over 12 months because we do have a bit of seasonality within our business. So we take a 12-month rolling average churn rate and just under 1%. And that rate has come down. And that's really a reflection of a bit more stability coming in the businesses that we serve, with fewer businesses going out of business or choosing not to have staff anymore. So that number has come down quite considerably. Excuse me. And when you reverse engineer those values, that means that customers on average stay with us for 8.5 years. And that has gone up 13% year on year, which is a good improvement for us. So when you multiply all those together, it means that every customer is worth $7,109 to us, and that is a 10% year on year increase for each of those. And when you multiply that by all the customers that we have, the total customer lifetime value is just over 60 million, and that's 20% up on last year, and that's up because of both the number of customers and the value each of those customers is to us. And another common SaaS metrics is the lifetime value to customer acquisition cost ratio. So we're getting 12:1 in that ratio, which is up 15% on last year, which is a reasonably solid number for us compared to some of our peers. So I'll pass you back to Asantha now, who's going to talk a little bit about the outlook.
Thanks, Jamie. So one of the key things in terms of outlook is that we continue to work on growing the revenue base out of New Zealand, and that is about acquiring new customers and being efficient about it. One of the big pieces of work that is underway around the customer support side of things is the use of AI in providing an exceptional customer care, but at scale without losing the intimacy that we have with our customers. It's really important that we don't lose that. How can we continue to care for our customers in a meaningful way, but do it at scale? And that's a significant opportunity for us to apply AI. And that's a big project underway that will allow us to scale, but not to have costs blow out as we scale. So it's about managing that, and you can see that reflected in the financials as well. We are servicing more customers, but we're keeping our cost to serve about the same number. That's really, really important as we look at new markets. The other place that we are looking at applying AI is around the customer experience point of view. One of the key things to understand about AI is a fantastic and it's a game changer for us. It is how do we make use of that, but keeping in mind that we have a duty to our customers around the privacy and the information that they share with us. We are responsible for 75,000 employees, and their private information. How do we manage to keep that safe and secure, but still make use of this new technology in providing a better customer experience? That's the work that is underway in the business. So we continue to expect that we will grow the fee revenue side of things. And as Jamie has said, we anticipate that there'll be further declines in the interest income, which is based on the market forecast and the commentary out there. We're expecting a further drop in the OCR that will be in this quarter, this half.
Yeah.
And we are also looking at, we're completely reorganizing the way we are acquiring customers. So there's some exciting work around the growth side of the business in New Zealand. And we're investing in both people and in solutions and systems that will allow us to acquire customers at scale in the New Zealand market. Focusing then on the Australian side, we will take the knowledge that we're acquiring every day from our interactions with our Australian pilot customers and the conversations that we're having with the Australian potential customers as well as the providers out there. We've got a launch that we've planned for February that we're working towards. The Australian tax year ends in June, so that provides a natural buy point of where people are considering changing payroll systems is towards the end of the financial year. There'll be some consideration to that. And there's a very important compliance-driven opportunity, which is the introduction of Payday Super in Australia. That, again, is a significant event that is putting pressure on payroll systems to change and to adapt to providing the ability for customers to file their superannuation payments and filing when they do a pay run, as opposed to the quarterly basis that they do now. It is a significant change that requires a lot of work to be done from all of the people providing a solution out there. We've built that capability from day one. So we are already Payday Super compliant. And so we know that that's something that people in market will be looking to change payroll systems because their payroll system might not be ready with it, or they might not have done all the work for that. So again, we see that as a significant opportunity for us to capitalize, because businesses think long and hard before they change payroll systems. It's about finding the moment, finding the opportunity, and then capitalizing on that. And we think that the Payday Super change coming middle of next year is a significant catalyst for people to change payroll systems. So our challenge is, how do we scale, get to a point, have brand awareness when someone's looking to change or get a new payroll system that is Payday Super compliant, they think of us and they come to us. That is the next 6 to 9 months work cut out for us in terms of a marketing positioning point of view. So we're confident that we can do it. We've done this before, and we will do it in the same considered but ambitious way that we've always built this business. So we are all eagerly awaiting the changes and the opportunities that are coming up, and we're confident that we've got the people, the processes, and the thinking to capitalize on this significant opportunity. So I think that covers the outlook for the next sort of 6 to 12 months for us.
Super, thank you, Asantha. Now we'll move on to questions. Todd, hopefully you're on the line. Have there been any questions come through from our investors?
Thanks, Jamie. No, we haven't seen any questions come through yet.
All right, in that case, I will I'll show you the glossary slide. So that's in the slide for those who want to understand the three-letter acronyms that come through, and I'll pass it back to Asantha to close.
Thank you so much. I really, really appreciate the support from shareholders who we got the message from shareholders that you need to hear more from us. You need to hear us articulate more about what we're doing. And we're working really hard at taking that feedback and being more deliberate about sharing our vision, our plans, and what we're doing so that you can understand and properly value our business. And that's something that we'll continue to work on. We thank you for your confidence, belief, and trust in us. It's something that we take really, really seriously. And we look forward to the next opportunity to talk to you in the new year. Thank you so much.